Good morning, traders. I've been working a lot. Haven't really been trading a lot. I've been sticking to two or three trades a week here lately, uh, and sizing down. A lot of times I'm trading at lots of five. Okay, so really small lot size on the option markets. I mean, haven't really been doing much. I did size up yesterday. Had a really nice win on arm calls out of near the gate, near the gate yesterday. So I had a nice little win on that yesterday on arm calls. Some things I'm looking at here, guys. So bottom line is, we know we're into major supply. We know this time around into this double top, we have record insider selling. That's even exceeding that of the prior all-time high. Okay. We know that uh, we're into this major supply, and recently the futures markets rolled into the new contracts. Okay, and they created a big gap up. That gap up is denoted, part of it is denoted right here, and that has not been filled on the futures market. So you know you're into major supply, so it only makes sense that if they want to take us higher, that they may need to repair the the gap, the futures gaps before they can actually take us higher into this major supply area. Okay, so be very mindful of that in your thinking going forward here. So these gray areas represent cash session gaps that have not been satisfied yet. Okay, so so be very mindful of that going forward here. Bottom line is, you're trying to build a house and you're into a major structural build point into the house. You have to have a solid foundation underneath of it. And if the futures markets have right at these highs are still sitting with a lot of gaps right here at the highs, it only makes sense that they need to put more bricks in to the foundation if and when, if or when we try to break out to new all-time highs. Right now, we have a foundation that are missing bricks, in my opinion. And so, it makes a lot of sense to me that we could very well be back down to 21,500 before the week's out. And I do want to point out here, if you zoom in here on these are the expected market maker moves for the week, and this study only works on the daily time frame. Okay, and I do want to point out, where's that at here? One second here. I got another study on there. I got to take that off. So we came into the week here with a very tight expected move for the week, likes of which we haven't seen for some time. And so market makers were not uh, uh, preparing themselves for a big move this week. We were coming in FOMC. They were not preparing for a big move this week. This is where the markets can really get surprised. Whenever you have a expected market maker move in a very tight range like this, that means nobody is prepared for a bigger move. So we have to be very mindful of this scenario. So we've looked above the expected moves for the week. Okay, and now we could very well be looking below. Okay, and we're already predicting a possible move back down to the 21,360 next week. That would still be inside the probabilities of the move for next week, and we could very well be seeing that before the end of the week, given the fact that our expected market maker move is not supportive this week. So it would not take much at all to get a flash crash in this market. So be very mindful, considering the futures are not supportive. The expected market maker move, the option markets are not supportive at the current prices. We have to be very mindful that this can move very, very fast. We also have some other things to talk. VIX is currently trading over 20. This is where things can get really jiggy. VIX is over 20. Things can start moving pretty quick. So what we're seeing that they prepared last week coming into this week, they were just all complacent. And but the VIX this week suggesting to us anything but complacent. Okay, so be very mindful of that. We also have the VX futures here, and I wanted to point out here, we came in here and then we did a really great double bottom on the VX futures, and we have all kinds of these gaps right above us here on the VX futures that have not, they're just, you tend to feel a lot of these gaps, and we've already seen, we saw a big trader yesterday. They were buying the 25 VIX puts for the 18 monthlies for July. So, there's a really good chance that here in the not so distant future, we're going to start feeling these upside gaps here in the VX futures. So we have to be very mindful of that going forward in our trading. I'm not saying I'm a big bear at these levels, which maybe I should be, but I am saying that it makes sense to hedge your positions and take far lower bullish uh, bullish, far smaller bullish size bets, given the current structure of the markets. Okay, so that's pretty much my main takeaway here that I wanted to talk about. Okay, yes, futures, similar situation. Okay, you zoom in here, and I want to point out here, very tight expected market maker move this week, and that's not supportive. So you have to be very mindful. You do not see historic expected market maker moves that tight. When they just wind, it's kind of like a squeeze scenario. When you see the market that suggests total complacency happened last week, and now that trade could start unwinding in a heartbeat. So be very mindful of this. This is a big warning. Seeing that level of tightness going into this week is a big warning. And then we have, like I said, poor structure in the VX futures. These are cash session gaps that have not been satisfied. Like I said, we could very well be down in the 59.40s before the end of the week. If you come over here going into next week, we're predicting a possible 58.90, 58.90 expected move, down here. And these are some of my old levels here that I got on here. Haven't updated it lately. But I did want to point that out. Some things going on here in the markets, going on. Our main support is not here. I mean, actually, this is still not a a hard support. Our hard support is actually more down here in the 58.80s, 58.60s. Okay, this is more of a supported area down at these lower levels, in my opinion, than they are, at these higher levels. So be very mindful of that going forward here. It still looks good right now, but I'm telling you, this can flip in a heartbeat. Okay. The Russell's really actually starting to show some relative weakness here. You see how my chart pattern here is? I think this is about to fail. And you see, bottom line is we had this breakout, and I just mirrored this breakout level, and see how we're finding resistance right here on the daily. Okay, we continue just to bump our head up here. This is 4-year resistance. We continue to bump our head into this 4-year resistance. This, to me, looks like it is starting to break down. Okay, guys, so be very mindful of this. And this is another one. It's the expected market maker move for the week is not supportive. Now, we've only got one trading day to go. Today is Juneteenth. The cash session is not trading today. The futures markets are. That's one of the reasons I was showing you the charts. I mean, you could trade futures today if you wanted to capitalize on a bigger downside move here in the markets. But I did want to point that out. And another thing I do want to point out here, the Russell futures, the IWM, they tend not to leave gaps. Okay, don't get me wrong, gaps do happen, but the gaps tend to get repaired. And we do have a little bit of a gap here that still has not been satisfied from the contract row. And I do think fully that we'll probably before tomorrow Friday's open, yeah, we will fill this gap in the overnight session. Now this is a cash session gap, so I would prefer to see that fill during the cash session. But but I do think you're actually going to see signs that feeling in the pre-markets, possibly before uh, the cash open Friday there. So be very mindful of that uh, going forward here. I would be very suspect. I hope nobody took too many longs, in my opinion. Uh, I do have a fairly large swing short for Friday. I look at my charts and stuff like that. Nothing major. I got 30. Uh, I've got 30. Uh, uh, 30 puts in the SPY. Okay. So that expired Friday, and they were uh, uh, right at the money. So I've got probably about, let me think here. I probably got about $1,500 or under $2,000. Yeah, a bet that we are going to continue lower uh, Friday morning. And I really think there's a very good chance that we're going to be coming down into these, like on the yeses here. I think there's a very good chance we're coming down into these lows. So, be very mindful of that. That's going to put us down in the 5940s into this triple bottom potential. So heads up on that. That's just kind of my food for thought, what I'm thinking here. And I'm not trying to be a perma bear. Trying to be a perma bear in this market has not really worked out, because bottom line is the Federal Reserve has actually been adding liquidity to the market to make the bond markets auction, to try to support bond yields, keep bond yields contained. Remember years past, we didn't have the Fed balance sheet. So you'd get runaway yields in the bond auctions. That's what happened back in the 70s. You just got the Fed lost control of the yields because they didn't have the Fed balance sheet to help manage those yields. Well, the Fed is actually, because of all the tariffs and everything, they're having to inject cash or they're having to put the bond auctions onto their balance sheet because there's just not enough buyers to keep the yields down. Does that make sense? I hope that makes sense. So basically, they have these bond auctions of all kinds of money that the government needs to run. Okay, well, they can put part of those auctions on the Fed balance sheet because they don't need that money right now, and then the Fed tries to sell those bonds back into the global markets, okay, at the lowest possible yield that they can possibly get, okay, as they can find buyers to take them, okay. And the problem is, with all the tariffs and stuff, you got far fewer countries willing to buy U.S. debt, U.S. Treasuries. Okay, so it's making it very difficult. And what's been going on? Japan's been buying a bunch of our U.S. Treasuries because their debt to GDP is almost twice as bad as it is here in the United States. So if we go down, they're going to go down even harder. So it's like they're buying up the U.S. debt because they can't afford the U.S. to trigger a recession. So that's what's really going on in the bigger scheme of the markets. And bottom line is, because what was going on, I don't know if you guys remembered the last big Japanese auction for the Japanese debt. They had trouble finding people to buy their debt because the global community is uh, uh, they're really upset about all these tariffs, and in my opinion, Japan's getting punished for uh, backing the United States in helping secure secure our T-bill markets. Because the best thing that can happen for the global community to come in a strong position on these tariffs is for yields to start losing control. And like I have been saying in prior videos, I fully think probably by the end of the year, the 30-year mortgage will be over 9%. Okay. We're hovering in the 7% range right now, but I do think it's going to be over 9% by year's end. And so be very mindful of that. And that has an inverse effect on home prices. So, be mindful of that. So bottom line is, you want to buy a house, you want to buy a house when it gets, and you got cash, you want to buy a house when yields are at 9, 10%. because the prices will be a lot lower then to pay cash for a house. Okay, so you're actually getting paid a return on your investment. You don't buy a house right now whenever yields are going up because you're actually losing the real estate's going down in value as those yields go up. So this is not the time to be buying a house, in my opinion. Okay, that's enough of my rambling. So, guys, this is a few things I'm looking at here. This was a risk-off uh, holiday, in my opinion, and you should not have been taken, in my opinion, short-dated bullish positions going into Friday. So hopefully you didn't. Uh, if you did and you succeed, please leave a comment below. I want to hear about it. And so I do appreciate any comments. If you guys disagree with me, write it in the thing, but be respectful. Right below in the comments. Like my video if you get a chance on my YouTube channel, and retweet me on X if you get a chance. I really appreciate it. I'll also have it on StockTwits. So thanks a lot. Just a few little things that I'm looking at here, and what's going on in the back of my mind, on these markets. Uh, but so we got a lot of things going on in the markets. It wouldn't take much to start, cracking things. It wouldn't take much at all. So be very mindful. Okay.